Go to the gentleman from New Jersey, Mr. Gottheimer, for 5 minutes.
Thank you, Mr. Chairman, and Chairman Powell for joining us today. Chairman Powell, when you testified before the committee last June, PCE inflation was up 6.3% year over year. Just a few weeks ago, PCE data showed that the numbers decreased to 5.4%. We're moving in the right direction, but despite the Federal Reserve raising interest rates at the highest rate since October 2007, we're still far off from the 2% inflation that the Federal Reserve is targeting. Do you believe 2% is still the right target for inflation? And given the ongoing energy transition, the push to shift supply chains out of China, and the labor shortage here in the U.S., should the Fed consider adjusting its target to avoid overly burdening Americans? Would a decline to 3% inflation be enough to offer price stability without excessive economic pain?
No, 2% inflation is going to remain our longer-term inflation goal.
Are you concerned given all the other factors that I mentioned, or do you think we just have to keep sticking with that?
I think that's got to remain our longer-term inflation goal. It's the global standard, and it's our standard, and this is not a time at which we can start talking about changing it. We have no instinct to do that.
Thank you, Mr. Chairman. The gig economy has grown significantly in recent years as more Americans are working as contractors or running small businesses. The Dallas Federal Reserve has written that gig workers are often not included in payrolls and not counted among the unemployed, and this may understate the number of Americans who could be counted as unemployed. The Fed has also noted the large number of Americans who are missing from the workforce after the pandemic. Do we need to change the way we think about measuring unemployment to account for these changes?
I missed the word you're saying.
Sorry, do you think we need to change the way we think about measuring unemployment to account for these changes?
I didn't catch this. You said, what was the word?
Oh, sorry, gig
workers.
Gig workers. I'm sorry, gig workers.
That's the word I didn't hear. Okay. No, we clearly need to incorporate gig workers both into the labor force and to whether they're working, and they certainly are working. We try to do that. It's not that we're not trying to do that. We may not be doing it perfectly.
Is there a better way to capture them? I'm just worried that you don't have the unemployment numbers may not, given we're still using older measurement ways. Are we updating our measurement?
We absolutely try. We're definitely trying to get those people, self-employed people. They do report in the household survey, I believe. I can get more for you on that, but I'm sure we're not doing a perfect job at it because it's a relatively new thing, but we're very well aware of it, and they're supposed to be included.
That'd be great. I'd love to talk to you more about that.
Great.
Thank you. As you're also aware, many of us are having discussions about the long-term fiscal health of our country and our economy. Like many, I worry that higher interest rates will put upward pressure on the national debt. CBO already estimates that annual interest costs will nearly triple for the U.S. over the next decade. You said to the Senate yesterday that interest payments are not a consideration of the Fed, but are you concerned that higher interest rates will more rapidly make payments on the debt unsustainable? And are there actions Congress should consider to address this issue?
So I'll say what my predecessors have said, which is that we're on an unsustainable path, and we really need to. Ultimately, we will get back on a sustainable path, and the sooner we get to work on that, the less painful it will be.
And rates, of course, were low between the financial crisis and the end of 2021, particularly low. After the target inflation rates hit, what do you think the new normal looks like in terms of rates and the Fed balance sheet over the next 5 to 10 years?
It's a really good question. There was a secular decline in longer-term interest rates, which we don't control, for 40 years to the point where they were, where the 10-year 10-year Treasury was at 10%, and then at the end of 40 years it was quite low. You're at higher levels. You're at, as you pointed out, levels we haven't seen since earlier in this century. I don't think anybody knows what this is going to look like 5 years down the road. So you have to ask, demographics haven't gotten better. Globalization may actually move a little bit in reverse, which would tend to produce higher inflation and thus higher rates. But you have to ask the factors that caused low rates, how much of that has changed, and some of it has, but much of it hasn't.
Building on that a little bit, what's the right metric, you think, for, if you're in our shoes, for assessing our fiscal health? Do you think we should be focused on maintaining a specific debt to GDP ratio, or is there a specific number? Are there other measures lawmakers should be focusing on?
So we've traditionally focused on debt to GDP, but many people pointed out before the pandemic that rates were secularly lower, and that therefore you could look at sort of real debt service. There was a lot of research on that, and by those measures, actually, debt service was much more easy to handle. Now we have the 10 years back close to 4%, and I think we need to be careful not to assume that these secularly low, longer-term rates are going to continue indefinitely, because that doesn't look likely now. And frankly, most forecasts have always shown things like the 10-year going back to a higher level, so it won't be that big of a change. I think it's more or less been handled, for example, by CBO that way.
Excellent. Thank you so much, and I yield back.